Dr. Arturo, please.
Thank you very much for hosting us. The first paper today is going to be on optimal monetary policy with uncertain private sector foresight. David López Salido, as was mentioned, is presenting virtually. Let's use, after he is done speaking for 30 minutes, we'll have a discussion, and after that, let's use the same rules that Neil set up in the previous session, where you raise your name card vertically, and then I will do my best to call on you. So with that, David, let me turn the floor over to you.
Thank you. Thank you. I hope that everyone is hearing me well.
Yes.
Thank you. Well, thank you again to the Bank of Japan for inviting me. I'm sorry I'm not able to be there. It's a pity, but due to a schedule conflict, I couldn't fly. I was looking forward to being in Tokyo. It would have been my first times, but I couldn't make it this time. So I hope you all appreciate that. Apologies. Thank you again. This is, as Cardi said, this is joint work with former colleagues at the board, Chris and Ed. And as usual, the disclaimer that you see in this page applies. So it's the motivation for this paper is kind of implicit in the title, or we hope it was. So the idea is to try to, with the backdrop of persistent post-pandemic inflation, revive it after the pandemic shock, and what's happening after the Ukraine conflict, and the implication for the energy prices, and what's basically going on right now is this idea of fears of the possibility of an anchor in long-run inflation expectation, something that most of the time is taken as given or exogenous, or basically under rational expectation, pretty much well anchored. And that's kind of an old topic. These inflation scares analyzed in the literature many times. So we try to give a new perspective through the lens of new macroeconomic models that put the expectation at the center of the transmission mechanism. So the key question is, how should the central bank set policy when the central bank lack information about expectation formation and faces risks about this inflation scare or an anchor in medium to longer run inflation expectations? So as I mentioned before, you all probably are well aware of a large research agenda on this topic. And what we try to, the angle that we try to use in this paper is try to use a relatively empirically realistic and novel setting to put forward this question again. And to do that, we are going to use part of our agenda that was pretty much following the paper by Mike Woodford in 2018, in which agents, instead of being completely or infinite forward-looking, has this final horizon planning, and we embedded that into otherwise standard macro model. The punchline was to, or the angle of this paper is to, given that, and I'll be very explicit about what I mean by that, try to go back to the work by Clarida and Gerler in 1999, Science of Monetary Policy, and try to understand how these leaning against the wind criteria and their discretion for thinking about optimal policy in the context of these potential uncertainty about inflation expectation, and to anticipate some of the key takeaways of our exercise, that these uncertainty about inflation expectation and potential and anchoring of inflation expectation add an extra element to this trade-off, to this criteria, leaning against the wind that is forward-looking, and capture a preemptive element to guard the central bank against this inflation scare element. And the fact that the central bank faces this uncertainty about expectation makes actually policy more aggressive on average relative to the standard model of the rational expectation. So in a way, if you remember the Brainerd attenuation principle, when the central bank was facing uncertainty about the transmission mechanism, is kind of a reverse in these contexts, as you will see in a minute. So the methodology that we use is to study, as I said, optimal monetary policy under discretion using this final horizon planning model of Mike Woodford with some tweak. In this setting, what we mean by final planning is that both household and firms plan for key periods ahead. So in a way, as I'll be very explicit about this, is a form of bounded rationality or K learning. You can think of that way. So they think ahead this finite number of periods, but beyond that horizon, their beliefs about the continuation value are pretty much averages of what they believe happened in the past. So in that sense, in this sort of model, there is a natural vulnerability to an anchored inflation expectation because of these inflation scare element attached to the limitation of going beyond certain horizon in planning about future state of the world. So on top of that, we incorporate some heterogeneity in the economy, and there will be uncertainty about how the population is actually behaving. To do that, what we have is to have some two-agent economy. One fraction of the economy has short horizon planning, and another fraction that have a longer horizon planning. This fraction is time varying, so the central bank will not know, will have uncertainty about what this fraction is evolving and how it's evolving over time, and that pretty much worsens these potential inflation and output trade-off frontier that the central bank will be facing in setting optimal policy. So the policy problem is we consider, again, optimal policy using a sort of loss function in which the central bank cares about inflation and output volatility. So on these uncertainty introduce what the literature and the central banks have emphasized, this risk management component or motive that create this preemptive optimal policy to fight any drift in long run or medium run inflation expectations. I'm hearing some noise. I hope that you all are hearing me well. Cardi?
We can hear you very well, David.
Thank you. So while we use the ANK, so we embed this new Keynesian, this final planning horizon into an otherwise simple three-equation model, with features certain new Keynesian elements. So why we do that? So in previous work, we actually try to prove that from empirical point of view, these models fit the data, aggregate data of the US relatively well. So we estimated this ANK model with final horizon planning. And I don't have much time to discuss today, but one of the nice elements of this model is that introduce what we call a source of endogenous persistence that is a key feature in macroeconomic time series data because of the combination of final planning with learning beyond the final horizon. We show in previous work that this element fit the model, fit the data better than the standard NK model that introduce element that incorporates, persistent like habit formation, any form of indexation, and so on and so forth, or changes in the labor market to understand better wage dynamics. Actually, what we show as well is that this model that introduces deviation from rational expectation also explains what the literature has emphasized regarding inflation forecast error. So we're able to explain the underreaction in the short run of inflation forecast error and the posterior or later overreaction that has been emphasized in previous work by Yuri Gornichenko, by Angeletos and others. So we thought that this is a natural model to think about this policy question that I just mentioned. So, and the mechanism, as you can see in the slides, is rather simple. So under final planning horizon with long run learning, this kind of is a way of discipline the modeling for making sure that we also capture potential drift that we have observed over the last 50 to 70 years of U.S. experience in inflation and output dynamics. So we incorporate, as I mentioned, uncertainty in expectation formation by having this time variation mix in the economy of a fraction of the agent with shorter and other fraction with longer horizon, and that's what creates inflation scale response to either demand or supply shock. We believe that the analysis has some policy relevant aspect, as I mentioned before, because it tries to capture the extent to which we deviate of these static criteria leaning against the wind that characterize optimal policy under discretion in this sort of setting. So what's the final horizon planning is, in a nutshell, is, as I mentioned before, a form of boundary rationality or K-learning, in the sense that agents within the horizon, say between T and T plus K, both household and firms, use all the structural relationship of the economy to evaluate as if all the contingencies over these K period, as if you can try to think about during this particular planning, they are using rational expectation condition on these final planning. What happened beyond the horizon, or what happened with this terminal belief? So then we need to think a little bit of good for work it out. What happened with the continuation value of both household and firms, and beyond that K horizon, what happened is that both firms and households learn from past data, and they're not fully aware of all the relationship in the economy after that. So that incorporates this departure from rational expectation. One of the interesting features of this approach is that the model have certain nice long-run properties, in the sense that in the long run, the model converge to rational expectations because of the way the continuation value is consistent with how household preferences and firms' maximization problem are set. So the beliefs about others is what is critical in this economy. The key assumption is that agents assume that others share kind of the same horizon when they are planning. This is the form of K-learning that I was mentioning before. So there is a common horizon of belief that they are thinking, and this is the second departure from rational expectation. So the first is that the planning is finite. The second is that they believe that all agents in the economy are alike when they are in fact not. And what happened is that it created this misleading policy perception gap. So agents perceive the central bank as having also this K period horizon, but the central bank has an infinite horizon plan used regularly under rational expectation. So as we will show, this creates a wedge between the perceived and the implemented policy. That is what we call this preemptiveness to fight against the potential of inflation scares. So some equations. So the model is pretty tractable up to first order. So this is just going to show you some log linear representation of the equilibrium conditions in the model. So let's think about agents within the planning period. So every day T type K agent, so an agent that have a horizon planning of K horizon, form a plan over that particular horizon, and we're going to use J to characterize how far from the end of the agent's planning period the horizon is the agent. So what is nice about this setting is that the beliefs within the planning horizon has this recursive representation, and this represents the beliefs about the evolution of price setting of prices within the horizon, has a familiar form of the kind of new Keynesian curve on these kind of Euler equation for characterizing aggregate demand. So you see two equations there. The first one is pi is the inflation at every point tau within the horizon that is connected to future inflation. So at J minus 1, the superscripts capture that's the inflation in the next period. And it's affected by what the agents believe is going to be aggregate output, aggregate demand, plus UT, U tau in this case, which is an innovation on the supply side. And saying likewise for the aggregate demand, characterized by within the period, like a standard equation, which, consumption of aggregate demand, it depends on future aggregate demand, and the interest rate, the real interest rate, in this case, the interest rate IT or I tau minus the expectation within the planning horizon of inflation relative to this equilibrium real rate that I represent there by RE. So both are very standard equation. But as you can see, this is something that is recursive within the planning horizon as opposed to the familiar representation for every period of time during the infinite horizon that we have on the rational expectations. So what happened at the end of the planning horizon, what happened with the end of horizon beliefs is what I show underneath these two equations that you see in the bottom of this slide. So at j equal to 0, that is when the agents actually ended the planning, these beliefs are pinned down by the continuation value VP and VH for price setter of firms and households. You can see there that what happened is that these equations are as follows. So pi naught and y naught are the value of inflation and output at the end of the planning, and this is connected to this continuation value. And those equations are consistent with, as I said before, preferences on profit maximization of all firms. And the other two equations show how the evolution of these value functions are outside the planning horizon, and they just follow a simple multiple learning rule in which this value function depends on past value function. And as you can see down there, what the agents estimate coming from their optimization period, that this value function will be the estimate value function. So through adaptive learning, as you can see there, you create some persistence in the evolution of inflation, the evolution of output, based on how these agents adjust these continuation values. And that continuation values changing over time is what creates a drift in inflation, produce this inflation scare phenomenon that can actually move inflation outside the rational expectation setting in a way that can create this problem for the central bank. So that's pretty much, in a nutshell, are the equations of the model. Very simple. So before I go to the analysis of optimal policy, let me just briefly mention that in previous work, as I mentioned before, we try to make sure that this representation of the equilibrium condition fit macroeconomic time series of the US relatively well. And we have a couple of papers showing that. And we did that in two different ways. So first we'll look at aggregate time series, and then we'll look at what happened with the ability of the model to explain the predictability in the forecast error that has been put out into literature regarding inflation expectation using forecasters' informations. And we have these in a few papers. The key question, as probably is in the mind of all of you, is how do we think about identification of this planning horizon? And to do that, we combine macroeconomic time series with information on forecast errors. And I'm going to explain briefly how we tackle that before I get into the policy. So here is from our previous work, 3 time series. Inflation is the top panel. Then the middle panel is what we call the inflation gap. So the difference between the trend component of inflation and the actual inflation. And the bottom panel is what we call this long run inflation expectation component coming out of a model. As you can see, we track relatively successfully this medium run or relatively low frequency variation in this series data. And what is interesting to us is that the model is able to capture this decay of inflation, the trend component of inflation in the US from early 80s, which is the bottom panel, until mid 90s. So you see how the model is able to explain this trend decay in this low frequency variation in inflation. And over the sample starting in the mid 60s, which is the top panel, I think the model does a good job featuring these low frequency movements in inflation. So that's one thing that we kind of, this is a very simple model, the one I just described, have no particular feature regarding introducing habit formation or adjustment costs of any nature or indexation. It is a plain vanilla New Keynesian framework with the only tweak of introducing this deviation from financial expectation that I just mentioned. So pretty successful in our view for doing that. Then we did the combination of not just caring about aggregate time series, but also we ran these predictability regression that Yuri Gorovnichenko and others run in the past. So here is what happened with the estimated model. When we run the regression that you have there at the top of the slide. So we correlate the inflation forecast error at time t coming from the different forecasters. It could be SPF, it could be blue chip. We combine all. It's pretty robust feature. And you see in the data that inflation forecast error today is correlated with the inflation forecast revision today. So the forecast revision is a good predictor of what the forecast today of inflation is. So the top left panel is this beta coefficient that we call beta coefficient Gorovnichenko coefficient. When we use our model, we run this regression using all the estimated shocks. So to see that the coefficient is significant, is close to 1. And then the other panel, and this is consistent with the evidence, of course, by Yuri and others. So we run this conditional regression because we can use our model to see, is this predictability coming from any specific shock that create any specific trade-off in output and inflation over the sample that I show you. And you can see there what we call conditional beta coefficients. The top right is when we have only demand shocks in the one that we estimate over the sample that I show. When we have supply shock only, which is the lower left panel, and when we have monetary coming from monetary policy shock. As you can see, the interesting feature here is that the demand shocks and monetary policy shocks, so I demand, tend to create this positive correlation between the forecast error at time t and the inflation forecast revision today. And this is coming again from this limited foresight of the agents in the economy. But when you face supply shocks, then coming from supply shock, this create a trade-off that actually water down this correlation between the forecast error and the inflation forecast error. So if anything, what we see, given our empirical analysis, is that the model can predict this sort of correlation, but mainly coming from demand shocks, less so from supply shocks. So that's another feature of a model that for feeding the data we believe is interesting. And this is the last features I'm going to show. Well, let me explain what you see right now in this slide. So what we did here is we ran a simple VAR in which we see the extent to which there is a and there are overreaction of inflation expectation to different kind of shocks. So this is an input response of the left panel of inflation in the model. The second panel is, as you can see there, is what the model is predicting regarding expected inflation 4 quarters ahead, what the model is predicting regarding the forecast error, which is the difference between the other two panels. So as you can see, both inflation and expected or anticipated inflation respond to shocks in the economy. And this is I think it's for aggregate demand shock, but for many others happen similar thing. What's interesting is in the right panel. So you can see that the forecast error initially is positive, so tend to overreact to the shock of the news. And then over time, the shock tend to create this underreaction. And these black lines, which are the model-based simulations, are within the bounds of our empirical model, that are the one that you can see they are shaded, coming from the VAR that we run with simulated data. So that's another final feature that we believe is interesting coming from these simple models. So basically, to create this over and under reaction, we need some kind of beyond this cognitive discounting that is breakdown because of the final horizon, this element of long run learning into the NK model. Okay, with that, I'm going to just describe briefly how do we close the model. As I said before in my previous slides, the aggregate economy is a combination of two agents, one with planning horizon K0 and the other with a planning horizon K1. So aggregate inflation and aggregate output, as you can see there, these two equations are just a convex combination of these two agents in the economy. And the omega fraction is time varying. And this omega fraction follows a Markov process that's going to characterize how these evolve over time. And the implication for optimal policy is that these introduce, coming back to Brader's original paper late in the 60s, this multiplicative uncertainty that breaks down certainty equivalence in thinking about optimal policy and in thinking about the issue at hand. So this time variation have about the planning horizon. So the planner need to think about what are these types. And for the exercise that I'm going to show you, we assume that there is a fraction with horizon planning 1 year and other agents that has a planning horizon of 32 quarters, sorry. So one are kind of myopic, just planning over 1 year, and the others are just looking through the business cycle. They look through 8 years. In our empirical work for feeding the data, as I mentioned before, the model is telling us to feed the data that we actually identify a K that is closer to 4 quarters than to 32. So we need certain type of, short planning horizon to feed well. Well, meaning what I just showed you, the dynamic of the macro time series of the US. So this omega t will allow to fluctuate with a Markov process to identify P, which is the transition matrix that characterizes this omega t. We estimate a latent process to capture how these can evolve. Those are the technical details. So how do we estimate using time series data from 66 to 2007 of the US economy? I'm not going to get into these details. So this is the result. So what we show here is the estimation of this fraction of this short horizon versus longer horizon planning. So we see that something happened in the mid-80s that is breaking the stability of these fractions. So prior to the 80s, we see that around 60% of close to 50%, half of the economy goes between these short horizon planning agents and longer horizon planning agents. And after the mid-'80s, so after the great inflation process coming out of the energy shock, so the economy tend to be, or the data tend to be satisfied that most of the agents in the economy start being much more far-sighted. So omega tends to be close to 1, short-sighted, so tend to be close to 1. So we believe that this gives us enough variability in this omega to make this exercise worthwhile, given that we use the combination of time series data from output inflation and the interest rate, plus these forecast errors of inflation in the economy, something that is not very common when we try to fit this NK model. Okay, with that, let me just turn into the optimal policy problem. As I said before, we try to be as close as possible to the Clarida-Gallia-Gerler standard analysis under discretion to have as a reference point, as a benchmark of our analysis. So let me start in this slide by telling you what is in the mind of the agents in the economy. In the mind of the agents of the economy, as I said before, the agents perceive that monetary policy is going to be set in a way that they believe that the central bank is also a K planning central bank. So because of that, they believe that the central bank is acting as if the time-consistent optimal policy only operate between T and T plus K. So within the final planning, and what we found, it was kind of nice, was that what the agents believe is between T and T plus K, the targeting criteria is exactly the targeting criteria that was obtaining these kind of models, which is the leaning against the wind. So you see, the agents believe that the central bank will be fighting inflation by creating recession, leaning against any inflation movement between T and T plus K. Using these criteria, as you can see, the leaning against inflation movement depends on kappa, which is the slope of the Phillips curve, and lambda, which is the relative weight of inflation variability relative to output variability in the loss function. That, of course, I'm not showing the loss function here, but it's a standard quadratic loss function in inflation deviation from target and output gap. So agents believe, as I said, that the central bank within the planning horizon is behaving as if the central bank is leaning against the wind. So how do they think about managing any shock by the central bank with this planning? So demand shock, they can be fully offset. So inflation will remain, on target, so there's no trade-off. But in response to a cost push shock or supply shock, there will be, a clear contrast. So the central bank need to offset that with these criteria by creating some output below potential output, so sort of recession to fight against these inflation movements, to avoid inflation scare spreading out on inflation expectation. That is not what happened here, because what happened here is the central bank is not implementing that perceived policy, it's implementing the policy that you can see here. So the optimal targeting rule under discretion is the one that you see in this slide. So you can see in that slide that there's two elements, inflation and output. And if you forget for now about the term on expectations, that I'm going to get to it immediately, you see that these criteria correspond to the Clarida-Gallia-Gerler. It's again the leaning against the wind that I just showed you before. But the deviation from rational expectation and this idea of lack of information or full information or the fraction of agents in the economy by the central bank and this final horizon planning introduce this extra term that has different components. So as you can see, this extra term is what we call the incentive by the central bank to anchor long-run inflation beliefs, and that is modifying the criteria as follows. So this component is first forward-looking. So the central bank is taking advantage of this inertia coming from learning in the economy to anticipate that inflation might be, an anchor due to shocks in the economy. So this WPT is what we call the marginal change in central bank discount loss from an increase in the valuation of the price setters. And this WPT, this term, as I said before, is affected by inflation, is taking into account that the agents know that has to fight harder to move inflation expectation back to target. And this kind of intensity in the fight against this inflation scare depends on this parameter APT, that is time variant, which is the elasticity of expected inflation relative to variation in the continuation value of the agent. So the extent to which the sensitivity of this near-term inflation to these longer-run beliefs by the agent. So what happened here relative to the standard criteria is, as I mentioned in my first slide, is that these introduce preemptive elements. So the central bank, when the economy is affected by supply shocks or by any shock that move inflation in a way that can create volatility in inflation expectation, or some sort of predictability in that inflation expectation, and persisting need to react much more aggressively to contract demand in order to damping any effect on inflation expectation due to this drift in longer run belief and potential de-anchor of inflation expectations. So this is kind of an effect that is in contrast with the attenuation effect that uncertainty induced in the context of the static framework by Bill Briner late in the 60s. So,
David, you have a couple of minutes and you can wrap it up.
Yeah, I'm almost done, Cardi. So what we did with this is in a model, we create different scenarios, taking a look at what happened in March 2023 using FOMC's SEP to design some simulations. As you can see here, this is the distribution of the outcomes under optimal policy, optimal discretion. So this is just using our solution method, what happened with the distribution of the output gap, inflation on the policy rate, and expected inflation. The key takeaway here is under rational expectation, you see that in response to shock, the output gap is close to zero. Inflation drifted to the right, and with uncertain planning, you actually take that into account, and you move and you anchor better inflation around 2%, as opposed to what happened in this setting when you do the wrong policy. So inflation tends to be drifted to the right and become a lot more dispersed, and you fight that with in our framework with this preemptiveness to avoid these outcomes. In terms of trade-off, this is the John Taylor well-known variance frontier that arise in these kind of settings. So here I'm representing the mean square losses from output gap in the x-axis, and the one coming from inflations. There are three different economies. One is the red with fixed planning, the blue with uncertain planning, and the rational expectation, which is the one at the bottom. So you see that the uncertainty about this degree of farsightedness in the agents, combined with this deviation of rational expectation and final horizon planning, create a much more complex and difficult trade-off for policymakers. You see the shift in this variance frontier to the north east. So to fight inflation volatility, you need to create, or to correct from output volatility, you need to increase all the inflation volatility to fight that. So the trade-off that the central bank is facing is a lot harder in this kind of setting relative to the standard rational expectation one. So to conclude, Cardi, just in the last 30 seconds, So we introduced this finite planning horizon in the otherwise standard new Keynesian model, but introduce, combined with this form of learning, the possibility of inflation expectation being, away in a persistent way from the target. That modified the optimal discretion in this setting. So introducing in the standard leaning against the wind a preemptive term to fight against these inflation scares that capture the extent to which inflation is responding to the continuation value of the firm that are unable and household to figure it out what happened in the future. In the 2023 episodal context, guarding against inflation scare delivers lower expected losses and potentially better outcomes in the context of a dual mandate central bank. Thank you very much, and that's all I have in my presentation, Cardi.
Excellent. Thank you very much, David. That was very interesting. Our discussant is Olli Segendorf from the Sveriges Riksbank, and please.
Should I stop sharing my screen?
I think the answer is yes. We're in novel territory, so
there you go.
Are you going to be presenting slides?
You should not see my screen.
Sorry, you're going to be presenting.
Yes, I have the slides here.
Okay.
Yeah. Okay, thank you, and it's a pleasure to be here, and thank you for the invite to this conference and to be able to to discuss this paper. And this paper addresses one of the most important practical questions we have in central banking today. What if inflation expectations are not perfectly anchored? And the paper is very elegantly combining rationality, learning, and optimal policy under uncertainty. It's very smooth. And it's also very relevant for all of us in the room. And my comments is more like from a practical central banking perspective, and my questions will also be in that direction. The mechanism is very compelling, but the questions are more how it interacts with communication, survey uncertainty, endogenous pricing behavior, and also risk of overreacting to supply-driven inflation. So let me just start with just sort of see if I can do it. Yes, this paper. So this, as David just told you, the key mechanism is that the household and firm plan over finite horizons. And as a result of this, long-run inflation expectations are not perfectly model consistent. And agents partly infer future inflation from what they see today, realized inflation. And this creates then the possibility of inflation scares, where inflation today can affect beliefs about inflation tomorrow. And since the central bank is uncertain how these expectations are formed, optimal policy become more aggressive. And this, as David just also told us, this qualifies this classic brain attenuation principle. So when uncertainty concerns expectation formation itself, uncertainty need not make policy more cautious, and instead make the central bank to react more forcefully. So main takeaway, I think this paper is excellent, it's innovative and very interesting. It's particularly valuable because it speaks directly to this real-world monetary policy concern after the pandemic and the inflation episode that was there. And central banks care enormously about anchoring expectations, and also in this context when inflation does not quite go down to target in many countries. So this is the core of central banking. And many of the models we use, many central banks worry more and more about the possibility of the anchoring should be in the core models. But at the same time, many central banks use communication as a complementary anchoring device. alongside the policy rate. So the policy rate is not the only mean to affect inflation expectations. And I will return to that later in my discussion. So this is a picture of Swedish inflation expectation and Swedish inflation. So you can see the 1 year expectation in the dashed line, and you can see 5 years long run expectations in the flat line. So the long run expectations have remained very close to target, despite, as you can see, this large shock to inflation. And this illustrates an important point. Central bank already devote substantial effort to expectation management. So one question to the authors is whether aggressive policy rate responses are the only tool for preventing inflation scares. And this Swedish experience and many other countries, of course, suggest that central bank may possess additional anchoring mechanisms beyond what is emphasized in the model. So some big questions. I have 3 here. The first one, so central bank models often, the framework often assumes that inflation returns into target. And in practice, this assumption can be embedded in the entire forecasting process. So the paper is very valuable because it forces all to think more seriously about alternative inflation regimes. And one implication of the paper is then that central bankers need to think more explicitly about about the possibility of de-anchoring scenarios. And the second point, the paper emphasizes precautionary tightening to avoid inflation scares. But aggressive policy may itself create non-linear risks to the real side. In this model, maybe you can solve it. In the reality, it might be a very important question. So could central bank become excessively focused on inflation tail risks while underweighting recession risk? And the third point I have here is that central bank maybe should distinguish between informed and uninformed expectations. So households very often report high inflation expectations, but these expectations from the households also have limited forecast accuracy. This is the case for Sweden and for many other cases. So should monetary policy respond symmetrically to these different expectations? And a little bit about some details. In the paper, you have the model interprets inflation persistence primarily through expectations formations. But inflation can rise because firms adjust prices more frequently or because they change prices by larger amounts. And the model captures mainly the size margin. But as many empirical evidence now show, during high inflation episodes, price frequency itself may become endogenous. So part of what the model interprets as expectation persistence may in reality reflect changes in pricing behavior. And second, the paper estimates longer planning horizons during the high inflations during the 1970s. And the interpretation is that high inflation increased attention. And this is, of course, plausible. But it creates an interesting tension. So if agents become more attentive, should they not also be more anchored expectations when they are more concerned about inflation? And also, as I said before, the cost of overestimating inflation scares. The paper focusing on that. But this cost may be particularly high when inflation is driven by temporary supply disturbances rather than persistent demand pressures, since they may generate large output losses. Okay, so more things to do about this. One implication of this paper is that central bank needs to anchor devices, and they need additional tools for that. And you need a narrative, as Mr. Kohn just said. You need a narrative of what to do. And one example, also from the Sweden's Riksbank, is to publish a whole strategy for what's next for the narrative. So we use a forecast for the policy rate to show where we are going, where we think we are going. We publish always alternative scenarios to show the risk, to span up the risk. And there is also attribute minutes from each board member where they discuss their own view on the decision from the majority. So just to sum up, the paper is very elegant and links finite foresight, learning, inflation scares. So a really good paper, and do it in a structural framework. With they have imperfect knowledge and inflation scared, and many people in this room have a long emphasized that. So yeah, I think this is very nice research and what is needed more of. Model to take expectation formation seriously in a structured macroeconomic way. Thank you.
Excellent. Thanks very much. David, I'm going to give you the floor for a couple of minutes just to respond to anything that you heard, and in particular maybe the points about state dependence and the endogeneity of attention. So, yeah, please. Yeah.
Thank you very much for the comments. So they're very nice comments. There's so many, and they're all very good. And we definitely we need to think more about these issues. Coming straight to the point that Kari thought about, and this is what we actually are right now in the middle of, which is this idea of connecting. You're absolutely right that from the empirical standpoint, when you see periods of high inflation, you see this increase in the frequency of price changes, but you see at the same time some movements in short and medium run inflation expectation, the extent to which you have a model that can explain or satisfy which are the features that matter probably most in terms of policy question is something that we're thinking. And what we're doing right now is try to endogenize the planning horizon by introducing these cognitive costs that the agency is facing, depending on the state of the economy. So to understand what's going on in the economy, you have to pay some costs, paying attention, try to be, conscious in the way you think about the economy, in thinking about how to form your beliefs, and that creates endogenously a way of thinking about how far aside you want to plan, as opposed to as an alternative mechanism of changes in the frequency of price changes. So what the effort that we're trying to make, and this is a well-taken point, is trying to see the extent to which all these empirical evidence that emphasize that you can explain inflation dynamics with changes in the frequency of price changes pay little attention to what happened with inflation expectation and forecast errors and the predictability of the forecast error that we see. And that's kind of the angle that we try to tackle with this approach and these more behavioral elements building into the NK model. But certainly more work needs to be done in combining these two elements. So that's what we are in the middle of right now, this idea of the extent to which the planning, as opposed to the planning for thinking or the planning for setting, your price plan, the extent to which you have to pay some cost for keeping your price fixed in response to lack of knowledge or lack of identification of what's going on in the economy. So this is an all question that many papers in the literature have tried to think about that. So we are kind of thinking hard through the lens of these new models and try to capture again the key point allowing us to fight, the critique of the extent to which you can identify our mechanism relative to the other mechanism in the data. And for that, we are just using expectation combined with aggregate data and to some extent micro data. And you raised another interesting point that I don't have an answer for that, is that what expectations we're talking about. Those are household expectations, firm expectations. So a lot of interesting work has been done on that. We should be also thinking about that. And then you have also other interesting questions about the extent to which, remember this exercise is deliberately simple in thinking about discretion to have a static targeting rule, not solving the optimal policy under commitment. This is something that we're trying to do. It's a little harder problem to solve under commitment, not impossible, but we're thinking about that. And these actually element of finite horizon planning and a lack of knowledge about the true state of the economy and how the economy works beyond this planning horizon introduce these forward-looking elements into an otherwise static criteria. And again, just in terms of policy, as I show in my slide, let me just put it, Kari, if you allow me for a second.
Only for 5 seconds, because Athanasios has been waiting patiently. So.
Sure. So here are my slides, and here you can see in these that what happened under our criteria is to fight inflation and to move inflation back. You really need to have, on average, a tighter policy, and that tighter policy is what is, the key implication for this exercise. Okay, so I stop now.
Okay, thanks, David. Athanasios, please.
Thank you, Chair. And thank you, David, for this wonderful paper. I'm going to start by making the comment that I think it's so nice that you're reiterating the key point in Marvin Goodfriend's work from 30 years ago about how important it is to tilt policy in a way that keeps inflation expectations anchored. That somehow, even though it was known 30 years ago, it seemed to have been forgotten in the post-pandemic period by a number of central banks around the world. So it's very, very nice that you bring this back. I want to ask about the one question that came up in Asa's discussion, and this is how the communication of an inflation target in addition to the other elements of the policy framework can help improve the anchoring of inflation expectations and reduce the cost. So I was wondering, there had been work in learning models, as I'm sure you know, where if we could make the assumption agents learn with a known inflation target versus agents learn with an unknown inflation target, there are significant benefits if we can assume that everybody in the economy knows what the inflation target is. And this is one of the theoretical cases for in favor of an inflation targeting framework. But this depends on how expectations are formed. It depends model by model. And I wonder, in your setup, is there a way to capture that element of communication in your setup that can help us reinforce the importance of announcing and sticking to a clear inflation target?
David, you have less than 2 minutes, so please go ahead.
Thank you. So thank you, Athanasios. Thank you. You are absolutely right. This is, in a way, a tribute to Marvin and all his work that you know very well, and probably most of the people in the room knows well. So it was kind of interesting that it came out so naturally in this new setting in which you have a simple model that kind of formalize all his beautiful ideas. So you're absolutely right. So in our setting, agents know what the inflation target is. So the problem is that the central bank doesn't know how the agents are planning and thinking about the credibility of these inflation target because of the limited foresight of them. So I'm pretty sure that there are ways to incorporate these element that you mentioned, the extent to which this 2% is not credible. The idea here will be slightly different. and we might not even need to have heterogeneity in the economy. And my guess is that the lack of knowledge is going to create, again, or the lack of, credibility, or the lack of information by the agents about what these terminal target or the long-run target would create a similar element that the one that we emphasize of being a little bit more aggressive, more preemptive in making sure that the agents understand that the central bank is not going to allow inflation to run high for longer, is going to fight against that. So I don't know if you saw during my presentation that basically agents it's kind of the basic mechanism. After or beyond the planning horizon, agents are going to use just actual inflation to figure it out, what's going on in terms of the extent to which you're moving far away from the target. So I guess that similar idea will be in place in the setting that you mentioned, in the context that you mentioned. So very similar to some of your work and John's work on these kind of learning models. But the basic principle, I think, it will stay. So because of this scare of inflation and an anchor of medium to longer run, better to forget about the Brainerd's attenuation and fight a little harder when you see inflation moving or drifting away from 2% for a certain period of time.
David, the only certainty that we have now is that we are at time. I really appreciate a great presentation and a great discussion. Thank you. And with that, this session is over.
Thank you very much. Thank you all. And again, thank you for letting me, be participating in this wonderful conference from here. And I'm really sorry I can't be there with all of you. Thank you, Cardi. Thank you all.
Thanks, David.